So while we talk about the long-term contracts and revenue recognition principles, sometimes what happens is that the firm actually finances a sale. Now, what do we understand by financing a sale is that all costs are incurred at once, and the subsequent revenue flow associated with the cost will probably flow over a period of time. So maybe over the next 5 years. So revenue will flow during this period, but there has been a cost which has incurred by the firm already. So in this case, probably you go for something like installment method. Now, just to give perspective on and an example associated with installment method, let's say you represent company A and you want to renovate your office with new furnitures. Okay. And the problem here with company A is that you don't have a lot of cash so that you can pay at once. So you don't have cash now, but you have enough cash to probably look at it from the point of view of installments. So if you want to renovate furnitures in your office, you may have to look at suppliers on the other side, and this supplier will supply furnitures to you. Now, since you don't have a lot of cash in the system, you want to enter into an arrangement where you can make payments of this office furnitures over a period of time, maybe over a period of 5 years. And if you look at from the point of view of the supplier, you'll notice that he has actually incurred all the costs, but he is expecting revenue over a period of time. So in this case, what he must use is something like an installment method of recognizing revenues. So let's look at what exactly and how exactly we can implement the installment sales method for recognizing revenue now. Now let us look at this example on installment sales method. So we have one company called KG Electronics, and that uses installment sales method to account for its sales. Now company has sold goods worth 100 million and the sales was 200 million. So effectively representing a gross profit of 100 million. This is 100 minus 200 minus 100, that is $100 million as gross profit. The following is the schedule for cash collection. So 50 million is collected in 2007, 50 in 2008, and another 100 in 2009. So what would be the gross profit for 2007, 8 and 9? So let's start with 2007. How much percentage is collected in the year of 2007? So this is basically 50 divided by 200. 200 is the total sales amount that needs to be collected, and 50 is collected in 2007. So this is 25%. So what we do is that gross profit would be equal to 25% of the total gross profit. So this is 100. So we have $25 as the gross profit reported for 2007. Let's look at what happens in 2008. Again, in 2008, we note that 50 was spent, and which leads to 25%. So gross profit would again be 25% of 100, which is the total gross profit here. So this comes out to be $25 million again. Let's look at what about 2009. So 100 million was collected. That is representing 50% of the total collection. So gross profit will be equal to 50% of your 100. So this is equal to $50 million. So this is how sales or installment sales method actually works. So while we had discussed about the installment method of revenue recognition, we had gone by an assumption that the collection of revenues is fairly assumed that it is going to happen. So it can be reasonably estimated, and we would be able to recover our sales collection. However, what happens if this collection is a real question mark? Maybe collectability is a problem or an issue. So in that way, you don't use the installment method. You actually go about using the cost recovery method. So cost recovery method actually suggests that do not recognize gross profit or sales or the corresponding costs till the time your COGS or costs is fully recovered. So let's take an example and see how it can be implemented. We'll go back to the previous case where we were discussing the KG Electronics case. we had seen that the overall cost was 100 million and the revenue was 200 million. So the gross profit eventually that company makes is 100 million. If we were to apply this cost recovery method, we will not recognize the gross profit till all the cost is fully recovered. So let's go in 2007. How much is the cost that is recovered here? It is $50. So 50 is recovered. In 2008, another $50 is recovered. So overall what we see is $100 is recovered by the end of 2008. So in 2007 as well as in 2008, what we do is we do not recognize any sales. Sales is zero. Cost associated with it also zero, or gross profit is also zero. So this is what we do for 2008. Now let's see what we do in case of 2009. Now since the cost has been fully recovered, what we essentially do is that we recognize gross profit in this year. So sales is now defined as 200, costs as 100. So your gross profit comes out to be $100 million. So please keep in mind that cost recovery is used when collectibility is a serious question mark and is totally uncertain. So otherwise you would have to go with installment sales method.